Episode 11, Stablecoins, recorded 26th of November 2019.
This is Bitcoin Basics Podcast with your host Ferris, that's me, and Gordon from Coin Compass. We're Bitcoin advisors and educators supporting business and individual investors to safely buy, manage, and control their private keys, Bitcoins. Visit coincompass.com for more information. This podcast is strictly educational and is not intended to be financial or investment advice. Full disclaimer in the show notes and at the end of this episode.
All right, we are recording.
Good morning, Gordon.
Good morning.
Now,
good night.
Can you tell me? Well, it's a morning at my end. It's not at your end. For all you guys listening to the podcast, we're probably both sound a bit tired. It's about 5 a.m. my time and midnight Gordon's time. Works out well. He's a night owl. I'm the morning person. So,
That's right.
Gordon, what can you tell me? What is a stable coin?
A stablecoin and the theory vastly differs from the practice, but a stablecoin is exactly what you think it is. It is a cryptocurrency that holds its value. So Bitcoin and certainly a lot of the altcoins, or coins as we've been told by Congress, are extremely volatile. So Bitcoin and some of the altcoins especially can move, $200, $500, even $1,000 in a day. So a stable coin is an attempt to remove that volatility and have a cryptocurrency that is consistent in its store of value.
All right. So who creates these stable coins?
Pretty much all the stable coins are created by third parties. And I guess we go into the background of what a stable coin is and who creates them, what the purpose is. A stable coin is a cryptocurrency coin that has some kind of collateral behind it, and either a cryptocurrency or a third party will manage the supply in it. So, for example, the biggest stable coin is Tether, and those who have been have anything to do with Bitcoin will know all the problems that Tether has had. And there are probably 4 or 5 major stablecoins, including Tether and TrueUSD. And they're one type of stablecoin which is essentially backed by something. So if there are $1 million worth of whatever stablecoin, so for example, Tether, if there are $1 million worth of Tether, there should be, and I put that in air quotes, there should be $1 million worth of actual dollars in reserve that can be redeemable for a token. The second type of stablecoin is a stablecoin that doesn't use traditional assets, but actually uses crypto assets. So it could use several or one, and there's some sort of complex cryptography behind that to ensure that the prices actually remain stable.
So with these stable coins, like Tether, for example, I know we're getting to the weeds a little bit here. Are they actually cryptocurrencies? So are they actually mined, or are they simply just digitally printed once someone deposits that equivalent in US dollars?
Well, without upsetting all the Ripple people in the room, Ripple is considered a cryptocurrency, but it's basically a spreadsheet. It's controlled by an organization. So I guess it depends on your definition of what a cryptocurrency is. They are cryptocurrencies in the loose term of the word. There are really 2 types, and one type uses some kind of peg. So for example, Tether, and that's the major one, will use as an analogy. So $1 will equal 1 Tether. And that cryptocurrency, the Tether cryptocurrency, has a blockchain behind it. It's not mined like you have in Bitcoin, like a proof of work algorithm, but it still has a ledger. And so in theory, and I put that in air quotes again, in theory, $1 that exists at a bank or exists somewhere is the equivalent to 1 Tether. The other kind of stablecoin is actually not pegged to anything. It uses various algorithms. It uses a basket of different cryptocurrencies, and it automatically or cryptographically adjusts things like the supply to make sure that the price is consistent. These algorithms are actually quite complicated in terms of their theory and what we call game theory, but they're the two kinds of stablecoins.
Okay.
The first kind, the pegging, is usually done by a third party, so a company. And the second kind of an actual stablecoin crypto is usually something decentralized. So it's not a third party or a company, it's actually a separate blockchain.
Okay. So why would someone want to hold or buy a stablecoin?
Yeah, so for anyone who's actually bought Bitcoin before, you have to send money, whether it's credit card or wire transfer or however you do it, to an exchange. And let's take a big exchange like Bitstamp or Binance. So let's say we send $1,000 US dollars to Bitstamp, for example. That Bitstamp will take, so that transfer will take a couple of days, and the CEO or the accountant or the secretary or the janitor will look up their internet banking and find that, okay, yeah, Faris has transferred $1,000, so we're going to update his account from 0 to $1,000. Now, you see a number on the screen that says $1,000 USD. Does that money really exist, or is it just someone updating an entry in a database? That's kind of the literal $1 million question. But the idea behind stablecoins is that it's too slow to move in and out of fiat, especially for traders and people who need to get in and out of a cryptocurrency quite quickly.
Sorry, just on that, Gordon, is Bitcoin is too slow to me for traders?
No, it's not the Bitcoin, it's the fiat. So it's the US dollars.
Sorry. Yeah.
Australian dollars,
Okay.
Canadian dollars, or whatever. So, for example, if you are depositing money to an exchange, then you've got, $1,000, you buy your Bitcoin, and then, you do a bit of day trading or however you want to trade. Then you want to get out of Bitcoin because you think the Bitcoin price is going down. Well, what do you sell into? You have to sell into something. So you sell into, for example, US dollars. I guess the controversy is, are you really selling into US dollars, or are you actually selling into magical numbers on a screen? And is that company, like, for example, does Bitstamp actually have those dollars, or are they just updating their database to say, yeah, you've got $1,000 access to you, but whether they do or not, we don't know.
Okay. Cool. Thanks, Gordon. And yeah, we actually did write about this in, I think, the November 2018 Coin Corner newsletter. So make that available for free on link up here.
I mean, that's a real use case, and that's sort of how they started. And also, the modern day use case is a lot of exchanges actually can't deal with fiat, so they can't deal with money. And the way to get in and out of the exchange would be, for example, I want to move not my savings. I want to move my account from, say, Bitstamp to Binance. The only way to do that is to actually buy Bitcoin, transfer the Bitcoin from Bitstamp to Binance, and then do what I need to do. But what if I don't want to buy Bitcoin? What if the market at the moment is totally tanking? I don't want to buy anything. I want to transfer my US dollars from Bitstamp to Binance. Well, I could, I guess, withdraw my US dollars to my bank account. That's going to take a couple of days. Then I could send from my bank account to Binance, and it's going to take a couple of days as well. Or I could use something like Tether and send my $1,000 worth of Tether straight from Bitstamp to Binance.
Yeah. Okay.
So in essence, it is just like a cryptocurrency, but that cryptocurrency is meant to be stable in terms of its value.
It's price and volatility.
Yeah.
Cool.
In theory.
Thanks, Gordon.
And something that I'm sort of on the fence about is tokenizing everything. So everyone keeps on talking about, well, let's tokenize some assets. For example, let's tokenize gold. And they could use something like a gold-pegged or backed stablecoin. Those of you who are probably listening to this are probably having a few alarm bells ring off. And there are certainly plenty of concerns. And I like the theory of stablecoins, but there are certainly many concerns. And historically, stablecoins have not really performed well. For example, one of the first stablecoins was called Newbits, and that started at $1, and that's still around today. And I actually looked it up this morning, and it's now at 51 cents. So you've got a stablecoin that's basically just lost half its value.
Yeah.
I would actually argue that stablecoins may actually increase volatility, because normally if you didn't have a stablecoin and you're in Bitcoin and you wanted to take profits, you sell out of Bitcoin into US dollars, leave it there for 2 days, maybe even transfer it back to your bank account. But because there's that option of transferring it from Bitcoin back into a stablecoin like Tether, you're probably more likely to speculate on the volatility in the short term. So it may actually be exacerbating the problem of increased volatility.
And the reason these stable coins exist is, as you mentioned, a lot of the Bitcoin exchanges simply are unable to deal in fiat. They can't receive customer deposits. I've had too many instances where I've tried to buy Bitcoin with my credit card, just for my credit card provider to decline the purchase because they didn't like the location of the bank. So these stable coins exist because the exchanges are not allowed to operate as they want to. They want to be regulated. They want to, comply with KYC and AML. But because they're being prohibited from doing so, they've had to create these stable coins. So I think the more mainstream Bitcoin gets, the less hurdles it gets from banks and governments. I think we'll eventually see the eradication of these stable coins.
Yeah, I mean that's a good question. I mean, an exchange could operate without a stablecoin. So, for example, they just accept fiat and transfer that into Bitcoin. But then you get the same problem as well. What happens if you want to take profits? What do you actually then sell your Bitcoin into?
Yeah. Okay.
Yeah, that's sort of the main quandary.
Cool. Thanks, Gordon. I think we probably went into more detail than we wanted to on that one, but this is the world of Bitcoin.
Oh, way more detail. I like getting into the weeds, and it's good. It's good fun.
All right, cool. Well, thanks, Gordon. There's a lot for us to chew on there, and I think this is something we'll have to tackle in depth in maybe one of our newsletters as well.
Definitely. And I didn't even mention Libra.
Yeah, it's a topic for another day.
Yeah.
All right. Good. Thank you, everyone, for listening.
That's a wrap.
Thanks for watching or listening. Please visit coincompass.com/free to register to our socials and discover other free content. Subscribing, liking, and following helps this content remain ad-free. Until next time.
Disclaimer. Any content provided by Coin Compass or the Bitcoin Basics podcast is for educational and informational purposes only and is not investment, legal, tax, or any other professional advice. A qualified professional should be consulted before making any financial decisions. Coin Compass or the Bitcoin Basics podcast will at times recommend certain products, services, and technologies, but these are opinions based upon our own or podcast guests' experience and not endorsements. We take no liability for out-of-date or inaccurate information, software bugs, manufacturing errors, technology misuse, or issues involving third parties. Visit coincompass.com for more information and please contact us.